Happy Friday, Eric Bible with the Bible team at Neo Home Loans. And yes, the streak continues. Mortgage rates yet again on the downtrend. As we kick off this glorious Friday, 30-year fix is at 6.35%, down from last week, 6.41. And I want to note, team, these are some of the lowest rates we've seen in over a year and a half. Now, the question is, will that trend continue? So we'll dive into that this week. A weakening economy, a weakening labor force, what that means for rates in real estate, and seller concessions. Are they still paying buyer's agents commission? Sneak preview, yes. So let's dive into what has continued this rally down, what this means for the Fed, and then we're going to close with seller concessions. So first and foremost, labor market. With the beginning of this economic cycle, as I've pulled up almost every single week, it said inflation was the forefront, which drove the Fed to respond, which ultimately drove mortgage rates higher. Yes, that's still important. Yet, over the last few months, the focus has come to the labor market. And really, that is where we have seen mortgage rates respond over the last month, finally in our favor. And it looks like that trend is going to continue. So this morning we received the all-important Bureau of Labor and Statistics, the BLS jobs report for the month of August. As we know, last month, that is what ignited and kicked off this rally we've seen as of recent. Well, it did not fail us again this morning. We saw 142,000 new jobs created as opposed to the 160 forecasted. With that, unemployment moved from its 4.3 to 4.2. And now the question on everyone's mind, and really I know the Fed's mind, is where we absolutely know with almost 100% certainty, given what almost every voting member of the Fed has come out as of recent, including Jerome Powell, and said rate cuts are coming later this month. With this new information and the hypersensitivity on labor, will the Fed cut now by 50 basis points or 0.5%? Yes, time will tell, but looking at some of the market forecasts, yes, it's very early in the day. There's still almost 2 weeks before the Fed will meet. But at this point, it is appearing that the 50 basis points cut is now in line. And what that means for us. Now, as we know, the Fed does not control long-term mortgage rates or long-term rates for that matter. It's more what banks lend or charge one another to lend money on an overnight basis, really short-term debt. But what that tells us is long-term mortgage rates respond, and there is correlation. And that brings me to my next point, the yield curve. Yield curve is ultimately a reference point looked at when forecasting the economy. Investors really spend a tremendous amount of time analyzing this. Well, I've mentioned this before. The 2 and the 10-year treasuries had been inverted for over 700 days, the longest since the 1929 stock crash. Now, what that means is the 2-year, so short-term debt securities produced a higher yield than that of long-term, so the 10-year, meaning people were parking money and experiencing a greater return in short-term durations as opposed to long-term durations. Historically speaking, when we see an inversion of the yield curve, it's a leading indicator to a recession. When that yield curve uninverts, it's predicted 11 of the last 12 recessions, and that happened this week, and it's remained uninverted since. So tying this all together and what we can bring to our consumers, it does appear that we're headed towards an economic slowdown. If not, we're already in one. And given what's happening globally, in the Asian markets, in the European markets, here domestically, it does appear that a slowdown is here. And coupling in labor, it's a foregone conclusion. Now, we hear recession, we immediately go doom and gloom, and 2008 still resonates. it's still very painful. However, we have to look at it from a global picture. Historically speaking, recessions lead to lower rates, lower mortgage rates, lower costs on credit cards, loans, you name it, which in turn increases affordability. We know affordability has been the center stage in this cycle, both from a buyer and seller perspective. So, where yes, a recession is fearful, but a recession for real estate, mortgage, real estate agents, buyers, sellers, over time and through history has proven to be very, very good. So it's doom and gloom, yes, but doom and gloom can benefit and appears to be benefiting our sector. So definitely something we're going to continue to keep eyes on. But for now, it does appear that this trend is holding. And then lastly, I want to close with seller concession. As we know, NAR August 17th went into play. So much concern and confusion around that. Our team has received a number of contracts post August 17th, and every single one, the seller has produced a concession to pay the buyer's agent commission. So it is still there. We're hoping this becomes the norm and the noise dies down. But on this end, sellers are still paying the buyer's agent commission. So it's wonderful news there. With that, all eyes now move to the Fed, but as it sits, mortgage rates are at the best levels we've seen in over a year and a half. This is an opportunity for our buyers and sellers to harvest some savings and approach housing from a new affordable standpoint. As always, if you need help communicating this message, know that we're here and would love the opportunity to support you. As always, make it a great Friday and an even greater weekend. Thank you.